Hi everyone, and welcome to Week 6 practice exercises. In the video today, we will explore various ways to allocate overhead costs. The total overhead cost of the 214,000 that you see here, that will not change. The only thing that'll change during this video is how we apply the cost across various products. So we'll see how using single plant-wide overhead rate or a multiple department rate or the activity-based costing rate impacts management's perspective of the true cost associated with producing an end item. We'll also discuss product cost distortion, factors that impact a company's choice of cost allocation method, and the importance of differentiating between correlation and coincidence. So let's go ahead and get started. In our problem set today, we're going to follow a company called Big Sound. They manufacture two products, receivers and loudspeakers. What you can see here are the factory overhead rates. And again, you're going to see this 714,000 popping up multiple times. We're going to skip this piece right here. We'll come back to it in just a small bit. As we move down, you'll see that the activity base associated with the two production departments and the two production departments that we have are the subassembly and the final assembly. They base their activity on direct labor hours. And here you can see that we've got our budgeted costs for setup and our budgeted costs for quality control. And then finally, we have this activity-based usage quantities, and we'll be using this for the activity-based portion of the video. Okay, so the first thing that we need to do is determine the single plant-wide overhead rate. Well, that's going to be quite easy because what we end up doing is we just pick up the total cost for our overhead, and then we pick up the number of units that we produced. Well, we have two products. We have receivers and loudspeakers. So that tells me that we have 14,000 units that we produced this period. And now we just want to calculate the factory overhead rate by unit. And we do that by taking the cost and dividing it by the number of units. That was pretty simple, right? Single plant-wide overhead rate. All right, so the problem set is rather long, so I'm going to start hiding some of this so that we can continue to see the information that was provided in the problem set. So now we are going to determine the factory overhead rates under the multiple production department rate method. With this one, we're going to assume that indirect labor is associated with the production departments so that the total factory overhead is 420 and 294 for the subassembly and final assembly departments. Now this is where I want to pause and I want to come back up to the top here. So when they say the indirect labor, they're talking about this piece right here. And you can see that as I summed these two up, it came out to the 400. But basically we're saying that the overhead that we had already accrued here in the subassembly department and in the final assembly department, what we want to do is we want to add that indirect labor to the total to get the 420 and the 294 that is listed in 1B. So here's my departments, my factory overhead. We've talked about where those numbers came from. And then we want to capture our direct labor hours. In this problem set right here, the only thing they're asking is for these numbers. But in order to get here, it's easiest if we lay it out so that we can see what our overhead is and we can capture what our direct labor hours are. Because in this one, that's how your overhead is allocated, is based on direct labor hours. So the 1,400 comes from here. This is my subassembly department, and this is my final assembly department. And it's telling me that we spent 1,400 hours in subassembly and 1,400 hours in final assembly. Now, calculating this last piece, is simply taking my cost and dividing it by my cost driver. And like I said in this one, our cost driver we determined was our direct labor hours. Okay, now we're going to take this information and we're going to determine the total and the per factory overhead rates, and we're going to allocate it to each product. So we have our receivers here and our loudspeakers here. With the receivers, we have our subassembly and our final assembly. We know how much time each one spent how much time receivers spent in the subassembly and the final assembly. I'm going to shrink this down just a tiny bit. There we go, so that we can see what we're doing. There. Okay, so we know that we spent 875 hours on receivers during this reporting period, and we spent 525 hours on loudspeakers, and you can see the loudspeakers down here. So we lay in the direct labor hours, and then we pull in the production department rate, and we calculated that in the last section. And then from here, again, all we want to do is take our direct labor hours and multiply it by our production department rate. This tells me that the receivers in this example incurred $372,750 over this reporting period. And while that's important, we also want to see what the factory overhead rate would be by unit. So I've pulled down how many units we produced this period, which was 7,000. And then the calculation is again just to take that total cost and divide it by the number of units, which gives me $53.25. Same methodology for loudspeakers. That tells us that our factory overhead rate by unit for loudspeakers should be about $48.75. This cost allocation method is based on direct labor hours, which we were told previously. All right, I'm going to hide this so that we can go on to our last section, which is the activity-based costing. So the activity-based costing is a little bit more complex, a few more steps, but really it's the same thought process. We're going to determine the activity rates, and we're going to assume that the indirect labor associated with activities rather than with the production department. So we have setup, quality control, which is our inspections, subassembly, and final assembly. And you can see that up here. We have number of setups, number of inspections, subassembly, and final assembly. Now we want to look at the activity base. Oh, I'm so sorry, I forgot to mention, let me scroll up, that these costs, the 138, that was given to us up here. And so was the 261, the 198 we got very early in the process, and that was up here. And the final assembly, same thing. Our activity base is how many activities in that particular category did we incur. For setup, it was 400. For inspections, we provided 2,200 inspections. We had 1,400 direct labor hours for subassembly, and the same amount for final assembly. So again, our activity rate is just going to take the total cost, and it's going to divide it by the cost driver, and that gives us our activity rate for each cost driver. Now, we're going to pause here for a moment. We can see right now that setup costs are kind of steep for each setup. It's $346.50 for each setup. This is going to be a huge cost driver as we look at which products have the most setups associated with it. Okay, so these are our interim calculations. Now we're ready for the final calculation. So we're going to use the information from above, and we're going to determine the total and the per unit cost assigned to each product. So same thing, we have got our setup, quality control, subassembly, and final assembly. We're going to look at the activity base that we actually used. And this first section is all about receivers. So the receivers had 80 setups. Quality control, they had 450 inspections, 875 hours in subassembly, and 525 hours in final assembly. I'm going to pick up those activity rates that we calculated in the previous section, and then I'm simply going to multiply it. 80 setups times $346. And so my total activity cost for setups for receivers ends up being $27,000 and some change. I'm going to do that for all of my activities, and then I'm going to sum it at the bottom. And we can see that we spent almost $250,000 on overhead cost for receivers. If we look over at loudspeakers, we spent almost $500,000 on overhead costs for the loudspeakers. And while that's a pretty big jump, we really want to see it based on the per unit cost. So again, we pick up the 7,000 because we produce 7,000 units for loudspeakers and for receivers. That tells me that my per unit cost for receivers is only $35, and my loudspeakers are almost double that. So now let's look at the summary of the overhead costs, and that's where we're at here. So now we want to look at everything side by side. We have our single plant-wide rate, we have our multiple department rates, and we have our activity-based costing. We were able to determine pretty early, and this was the easiest one, that if we used a single plant-wide rate, then we would allocate $51 per unit in overhead costs. If we went with the multiple department rate, then our receivers went from us allocating $51 to us allocating $53. As we refined our calculations a little bit more with activity-based costing, we realized that our receivers really aren't incurring $53 worth of overhead. They're really incurring somewhere closer to $35 in overhead. Now, management would actually use this type of an analysis to determine, do we want to continue to produce a product or do we want to discontinue a product? If we were using multiple department rates, a management accountant may recommend that we discontinue receivers. That would obviously be a poor choice because once we use a more refined costing system, we realize that receivers really aren't incurring a lot of overhead costs. It's really the loudspeakers. So as a management accountant, we would put something together to look at total cost and overhead, and if the company were looking to discontinue a particular product, this one might actually be one of the items that we list as a viable option. So, which of these methods should a company implement? And the answer is super frustrating because it really does depend. And some of the factors, by the way, there are tons of factors, but some of the factors that companies take into account is how big are we, and what is the volume of production. So if the company is relatively small or they're not producing a lot, maybe a single plant-wide rate is fine. But as volume production increases and as you add more and more products to your to your production, then single plant wide rate again could really lead you to believe that our cost allocation is even when it's really not. We also want to look at the ease of tracking cost drivers. If you work for a smaller company that's still paper-based, then the time and energy that it takes just to collect the data and enter it into some type of a software system, whether it's Excel or a specialized system, that really may just be more costly than it's worth. We also want to talk about the sophistication of our employees. So if our employees are not very sophisticated when it comes to gathering data or analyzing it or taking the data that a management accountant has provided and really implementing it to optimize your production and your operations, then again, it may be a wasted cost. And then the final one, which in my opinion and in my experience, the ability to correctly identify cost drivers, that's a huge factor to consider. So what do I mean by the ability to correctly identify cost drivers? Well, we see up here, where is it? Oh, here we go. In our setup, that each setup costs approximately $346.50. But what if we had never even identified setup? Maybe we had identified transportation as a cost driver, and we had said, so it's $138,000, and we drive 50,000 miles a month. That may actually not be a good cost driver, and it may actually harm our activity-based costing product. We may actually lead our management to make poor decisions, mainly because we started out with the wrong assumptions. In this one, I believe that setup is a good assumption and a good cost driver. So we need to understand the importance of differentiating between correlation and coincidence. And on that note, I'm just going to scroll down to this chart, and we'll talk about this chart really quickly. So in this chart, you can see that starting in the year 1820 and moving all the way through the year 2000, we notice that the number of pirates decreases as the years move on. This red line is the global temperature, or basically global warming. And we notice that starting in 1820, the global temperature was a little lower, and as we move to the year 2000, the temperature increases. Now, if we were not aware of how to differentiate between correlation and coincidence, we may falsely believe that that global warming has caused the number of pirates to decrease, or that as the number of pirates decreased, global warming increased, or global temperatures increased. Now, we instinctively know that this is not a good correlation. It just happens to be a coincidence. But as you start working in more complex financial operations or situations, sometimes it's a little harder to tease apart a correlation from a coincidence. And so if we can keep in mind how easy it is to confuse the two when you're looking at huge data sets, then it helps us to guard against making a poor assumption based on a chart. All right, thank you so much for joining me, and I will see you in the next video.